And welcome to the very first Accounting 651 corporate taxation video of the fall 2018 semester. We're going to talk about the operating rules of corporations, and most of this content is derived from chapter 3 of your text. So if you need to, you can refer to that. I'll also make these slides available to you. All right, let's get going. So we're going to talk about corporations in general and the double taxation, their rates, and we'll compare them to some of the other business entity forms. We'll talk about how to calculate taxable income, some of the things that are unique to corporations, and we'll talk about a couple of other corporate things to make sure we've covered that territory. Okay, so let's talk about corporations in general. So as we know, because we've discussed it, and presumably somewhere you've had it along the way, corporations are taxed as a separate entity. They have a unique tax rate. The character of the income is fixed as it comes out of a corporation, and losses are not passed through. So if a corporation generates a loss, its owners receive no current benefit from that loss. The corporation can have a net operating loss, but they certainly don't create any advantage for their individual shareholders. Dividends are not deductible by a corporation, whereas items like salary, rent, and interest can be. And of course, there's a number of non-tax issues related to corporations. One of them is the importance of limited liability. The shares of a corporation are liquid and easily transferable. It enjoys continuity of life, which means that even when the owners die, it continues on. Unlike a partnership, which often has the agreement has terms that say maybe the partnership doesn't go on if one of the partners dies. And corporations enjoy centralized management, right? So there is a group of owners, and those owners go out and hire management, and the owners become represented by a board, as opposed to often serving directly as management of the company. And of course, a corporation can make an S election if it wants that income to flow through. Okay, so all of that should be review. Any of that is not familiar with you, I'm pretty sure the book covers most of it. So let's talk about taxable income. So when we think about similarities between individual and, frankly, non-corporate taxpayers, gross income under Code Section 61 covers everyone, right? That's all sources unless that income is excluded. And deductions are generally under business deductions under Section 162. There is an underlying assumption that all corporations are engaged in a trade or business, and that is not the case with other types of entities. Now, you can end up with a personal service corporation, and you can have a corporation that generates passive income. But what happens is it gets picked up in some other taxes, frankly, or the personal holding company tax is the one that would get you if you were holding nothing but investments. Okay, so individuals are almost always on a calendar year end. We all individuals virtually file with a 12/31 year end, but corporations really have a ton of flexibility and can choose their year end. So they can pick a fiscal year end because their income doesn't flow through. It's really not relevant what the year end of the owners are. Whereas S corporations and personal service corporations, they're not as flexible. So, a personal service corporation, which we run across from time to time when we discuss corporations, that is a corporation that provides personal services. So, in the fields of health, law, accounting, arts, engineering, architecture, accounting again, that's how important accounting is. Those can be personal service corporations. It's also required that most of the services are performed by shareholder employees. So what that means is, of course, that the owners are just the accountants or the doctors or the lawyers that are engaged in the practice. And of course, more than 10% of the stock needs to be held by those shareholder employees. And the idea is this prevents you from incorporating yourself. So it's an attempt, if you will, to try to treat a personal service corporation as an individual. And as a result, they typically must follow the calendar year. And you'll hear, especially now that rates are lower, professional athletes have a long history of trying to incorporate themselves in an effort to try to shelter some of their income and not have it flow through to them. So when it comes to cash versus accrual, in general, the general rule is a corporation is not permitted to use the cash method. They must use the accrual method. However, like with everything in taxes, there are exceptions. So an S corporation is permitted to use the cash method. If the corporation's engaged in farming and timber, if it's a personal service corporation or a small corporation. So, of course, small is in the eye of the beholder, so it needs a definition. And fortunately, the Tax Cuts and Jobs Act now defines that as gross receipts of 25 million or less for the most recent 3 years, and that is ends with the year prior to the tax year in which you're doing the test. So, for example, if we're in 2018, we would look at 2015, 16, and 17 to make the gross receipts test determination. Okay. So, again, when we're thinking in general about corporate taxable income, capital gains and losses do not enjoy preferential tax rates in the corporate form. They also are not permitted to deduct net capital losses. To the extent a corporation generates a net capital loss, it either must be carried back 3 years or forward 5 years. And we'll talk a little more about carrybacks and carry forwards when we get to NOLs so that you understand what those are. And to the extent there is a cap loss carryback or forward, it's always treated as short term. Now, that's considerably less relevant for corporations than it is for individuals. And the rule is different for individuals as well. So if ABC Corp generates operating income of $40,000 and a net short-term capital loss of $4,000 in its first year, well, because it's in the first year, it cannot carry it back. But it also cannot deduct it. So what that means is that ABC Corp's taxable income is $40,000, and it will carry forward that $4,000 worth of capital loss and treat it as a short-term capital loss for future periods. Okay, since there is no current deduction for net capital losses, if Basilisk Corp starts in 2016, and then in 2018, Basilisk Corp has operating income of $100,000. Long-term capital gains of $4,000 and short-term capital losses of $9,000. Well, the first rule of capital gains and losses is first you net any short-term gains against any short-term losses. Then you net any long-term gains against any long-term losses. So the presumption is this is all we have. So now we would net any short-term gains or losses against any long-term gains or losses. And netting implies that the sign must be different. And that's the case here because we had a long-term gain and a short-term loss. So when we net those together, we end up with a $5,000 net capital loss that simply isn't deductible. But we need to look and see, can Basilisk carry back these net capital losses or try to carry them forward? So any carryover amounts would be used on a FIFO basis. So that means if I generate a net capital loss in the first year, I have to use that one before I could use up any net capital loss generated in the second, third, fourth, or any year thereafter. So since in 2016, Basilisk generated $100,000 of income and long-term capital gains of $1,000, and in 2017, they generated $100,000 of income and long-term capital gains of $3,000. Okay, so now we know what's happened since Basilisk started in 2016. We know what's happened in its 2 years of operations prior to this net capital loss that it generates in 2018. So the first thing it has to do is carry back that loss to the first year. So it can't go back 3 years. It can only go back 2 years. So it will carry it back to the 2016 tax return. And what a carryback means is you would actually think of it like open that return up, amend it by reducing its capital gains by $1,000 down to zero because it had capital gains of $1,000, and then filing for a refund. It would then look at 2017 and say, oh, well, I had capital gains of 3,000. Let me offset those 3,000 by amending that 2017 return and getting a refund. Unfortunately, then it is out of carry back capital gains. So as a result, the 5,000 of loss that it generated in 2018 minus the 1,000 it used in 2016 minus the 3,000 it used in 2017 leaves in a remaining carry forward amount of 1,000 that it's going to have to use in future years. Okay, so depreciation recapture is generally the bane of every novice tax student's existence. But unfortunately, it's a big deal for corporations because, of course, corporations naturally treat the vast majority of their property as being used in a trade or business, which means it's Section 1231 property, since 1231 property is business property held for more than 1 year. Recall that 1231 property is broken down into two subsets, Section 1245 property, which is personal property, and Section 1250 property, which is real property. Now recall that Section 1245 is personal property, and Section 1250 is real property. So real property is real estate and land, and 1245 property is basically everything else. So recall that the first thing we do is we net all our 1231 gains and losses. And if we net them together and it's a net gain, we treat that as a capital gain. And if we net that together and it is a loss, we treat that as an ordinary loss. But recapture demands that any gains that are really associated with overdepreciation should be recharacterized as ordinary. Or, that's under 1245, or gains on accelerated depreciation of real property or 1250 property, but only accelerated depreciation would be treated as ordinary. But recall that because 1250 property escapes full recapture, it only recaptures the accelerated part, there is a ex post punishment. That ex post punishment is that individuals retain long-term capital treatment for that non-accelerated depreciation portion, but they pay at 25% long-term capital gains rates instead of the 0, 15, or 20. Corporations, on the other hand, when they sell Section 1250 property and none of it is subject to full recapture, they get whacked by Section 291, which says pretend it was 1245 property, take 20% of the gain you would have treated as ordinary and recapture that as ordinary. And notice that back many, many years ago, that was 15% that was recaptured. That's clearly hasn't been the case for a good long while now. Okay, so let's do an example. RB Corp purchases a building in 2006 for $1 million. Then looks like about 11 years later, the building is sold for $1.7 million. Depreciation of $360,000 was taken through the time of the sale. So when I look at the cost, the building cost $1 million. It was depreciated $360,000, which results in an adjusted basis of that building of $640,000. The amount realized on the realization event, which in this case is a sale, was $1.7 million, less the adjusted basis of $640,000 results in a realized and a recognized gain of $1,060,000. There's been no accelerated depreciation, recall, for years and years and years. So that means pretty much all the depreciation is straight line. That means that it was all unrecaptured. We're going to recapture to the extent of the gain, that depreciation amount. Well, the gain is well in excess of the unrecaptured depreciation. So as a result, under 1245, we would treat all $360,000 as ordinary. This is a corporation. So under Section 291, we take 20% of 360,000. That's 72,000 and treat that as ordinary gain. The remaining amount of the gain is treated as Section 1231, and to the extent that's the only gain, that will be treated as long-term capital gain. So that means the $1,060,000 minus the 72 results in the 988. Okay, let's mix this up a little bit and say that instead of selling it for $1.7 million, they only sell it for $900,000. Okay, in this instance, the adjusted basis is the same. The realized and recognized gain is 260,000. So even though we've taken 360,000 of depreciation, you never recapture more than the gain amount, which means that the unrecaptured depreciation is only 260,000 because it's maxed out at the gain amount. 260,000 times the 20% required under Section 291 is 52,000, and that leaves 208,000 of 1231 gain. And again, if that were the only 1231 gain, we would treat that as long-term capital gain. Okay. So another thing to consider is passive activity losses. So if you recall from your fundamental taxation somewhere along the way, when a taxpayer is engaged in a passive activity, which means they do not materially participate, then they may only deduct passive losses against passive income. And the reality is that applies to most taxpayers. But fortunately, the passive activity loss limitation does not apply to corporations. Now, the passive activity limitation does apply to personal service corporations, and it also applies to something called a closely held corporation. But that passive activity loss applies in a different way. So, personal service corporations are simply treated like individuals. So, no passive activity losses without passive income. But closely held corporations get a break. They may offset their passive losses against any net active income. That means it does not need to be portfolio income. And a closely held corporation is defined as one in which more than 50% of the stock value is owned by 5 or fewer shareholders at any time in the second half of the tax year. Recall that passive activity means there's no material participation. That would mean that there's no involvement on a regular, continuous, and substantial basis. So, owner participation, or what's called the 465 rules, we're not going to dig in on too much. One full time manager, 3 full time employees, deductions of greater than 50% of gross income. We're not going to worry about that too much. The net active income equals income that is not passive or portfolio. That definition, by exception, is a good thing, right? So, what that means is if you do not classify it as passive, you do not classify it as portfolio, that means everything else is net active income. Okay, and again, closely held corporation can offset those passive losses against any net active income that it generates. It does not have to be passive income. Okay, so what about in a business where there's blended passive and active income? Well, what happens is the predominant activity needs to be active. So that implies that 80% of the gross income is coming from some sort of active income source, and therefore you get to treat it all as active income. Okay, so shifting gears a little bit, charitable contributions are treated differently for corporations than they are for individuals too. And the way I see it is there are 3 issues associated with charitable contributions from a corporation. That's timing, amount, and any limits that apply. So first, let's talk about timing. So typically, that would be when they're paid, right? A corporation would deduct a charitable contribution when it's paid. But a corporation may also may accrue a charitable donation if the board approves it and it's paid by the 15th of the 4th month after the end of the tax year. So for example, a calendar year corporation, that would be by the tax filing date of April 15. So what is the amount? So the amount is pretty straightforward if it's a cash donation, right? So if I donate $100 of cash, the charitable contribution amount is $100. That's very straightforward. If, on the other hand, I donate property instead of cash, the value is typically the fair market value of that property. However, there are 2 exceptions to a corporation taking the fair market value as the amount of the charitable contribution. One is if they donate tangible personal property and that charity puts that to an unrelated use, then the amount that the corporation deducts is only the adjusted basis of that tangible personal property. So let me give you an example. A piece of tangible personal property might be something like, um, I don't know, a copier that it owns, right? So a factory or a corporation owns a copier, and it decides that rather than try to sell that copier, it's going to just donate it to a charity. That's tangible personal property. If the charity's going to then use that copier for that purpose to make copies, which presumably is related to its charitable operations, then in fact it will take the fair market value. If, on the other hand, it's simply going to sell that copier, then it takes the adjusted basis as the charitable contribution amount, or the corporation does. Okay, if a corporation donates ordinary income property, and that is almost exclusively inventory, then it takes the value as the adjusted basis of the inventory. It does not take the market value. However, there is an exception to that exception. That exception says, okay, what if you donate inventory to a charity and the purpose of that charity is to care for the ill, needy, or infants, or that is tangible research property donated to a qualified educational or scientific organization. In both of those cases, right, so those are rare exceptions. I'm giving inventory to that kind of charity, or I'm giving research property to a school, is really what it boils down to. Then, if that property is in fact used towards the mission of either the charity or research, and there's no quid pro quo, meaning there's not some form of exchange, right? So I give it to you, and as a result, you do my research, or I give it to you, and as a result, you promote my products. As long as that's not the case, then they don't get fair market value. Instead, they get the lesser of the adjusted basis plus 50% of the appreciation, or 2 times the adjusted basis. So we better do an example. So let's say X Corp donates inventory, and its basis in that inventory is 80,000, and the fair market value of that inventory is 200,000. So if we were to apply the general rule, that's ordinary income property, the donation amount is considered its basis. If, on the other hand, it meets the special rule, so let's say that inventory goes to a charity for the needy or for infants, and it's going to be used for some sort of purpose. So let's say it's Procter and Gamble, and they donate diapers to a charity that's going to, in fact, give those diapers to needy families. Then what would happen is Procter and Gamble would multiply the increase in over the basis by a half. So that's 200,000 minus 80,000. That's 120,000 times a half, or 60,000. And then it would compare that to what is 2 times the basis, right? So 2 times the basis is 160,000. So it takes the 60,000, adds that to the basis of 80,000. That's 140,000. Since 140,000 is less than 2 times basis, then it takes the 140,000. If a corporation donates capital gain property, and again, capital gain property is pretty rare for a corporation, but it does happen. If it's long-term capital property, then the general rule is it goes out at fair market value. It goes out at basis if that property is a patent, copyright, trademark, or similar intangible. If it's tangible personal property and unrelated to the donee's purpose, or if it goes to certain private non-operating foundations. So if you ever wondered what the difference was, a public charity gets its money from the public. A private foundation gets its money from a single source. That's typically a family, or not family of, a family or a corporation. And then there are two kinds of private foundations. There's a non-operating foundation, and that's one that actually does not engage in any charitable activities itself, but rather is a source of support to other charities. So, for example, the Trump Foundation may not engage in any I'm making this up, by the way. May not engage in any charitable activities itself, but rather makes payments to other charities. Whereas an operating private foundation actually supports its own programs. That's just a sidebar. Okay, so what limitations? So we've been through timing, we've been through amount. What are the limitations? So the limitations on a donation by a corporation are 10% of what's known as modified taxable income. So what is modified taxable income? Well, that's taxable income. Of course, you add back any charitable contributions. You add back any NOL carry back into that year. You add back any net capital loss carry back into that year. You add back any dividends received deduction, which we haven't even covered yet, and you would have added back the DPAD. Now, we're not going to cover the DPAD in depth anymore because the reality is it doesn't exist. It got repealed by the Tax Cuts and Job Act. But there is some possibility that you would be looking at a corporation that had charitable contributions limited in a prior year. And you might see that and be like, what's the DPAD? That's the Domestic Production Activities Deduction. And it had to do with a special deduction for corporations that were in, it wasn't just corporations, businesses that were engaged in production activities. Okay. So, given all this, let's think about this for a second. Why would a corporation even make a charitable contribution? Okay, so let me give you the jaded view first. So, let's say that this corporation is owned by owner A, and owner A simply loves the opera. So, owner A can have the corporation pay her a salary or pay her a dividend and then turn around and donate post-tax dollars to the opera. So think of that. If owner A receives a salary, it's true the corporation takes a deduction for that salary, but of course owner A pays taxes on it, right? And employment taxes on it. If it's a dividend, the corporation doesn't even get a deduction for that, and it's double taxed income. So that's a very inefficient way for owner A to get money into the hands of the opera. So the alternative would be owner A, who happens to be the sole owner of the corporation, can simply say, corporation, you make a charitable contribution to the opera. As a result, the corporation does in fact take a deduction. Owner A's never taxed on any of that, either from an employment tax or income tax perspective, and that money gets to the opera. So in some respects, that's a pretty good outcome for owner A. A less jaded view is simply that corporations want to be good citizens, they want to develop goodwill, and they want to help the bottom line. Okay, so when we look at article by the Harvard Business Review, right? So think of it as the model is there's a social benefit that comes from a corporation providing philanthropy, and there's an economic benefit that comes from that. And really, when you think about it, probably the situation is most corporations are in that gray part of the triangle, which is they're seeking some form of both combined social and economic benefit, right? So they want to develop goodwill. They want society to think they're a good corporation. Let's face it, corporations don't have the best reputation to begin with, and maybe they also are actually interested in some form of social benefit. For example, I want to support the opera. Like as you think about it, the opera is a pretty jaded perspective, right? Owner A could have loved schools, or it could have loved programs that feed the needy or the poor. All those things would have been a little less jaded feeling, and it would have been an efficient way to get that money down to them. Okay, so we've been going for 29 minutes, which probably means that this is a good time simply to take a break in the video. It doesn't mean the videos are over. It simply means I'm going to post a second one after this. So let's just cut this one off, and I'll see you in video 2.